Imagine the government is doing everything right. Interest rates are near zero. Loans are cheaper than ever. Banks are full of money, ready to lend. But something strange happens. People stop borrowing, businesses stop investing, and the economy slows down anyway. It doesn't make sense, because cheap money is supposed to boost growth. But in this situation, it does nothing. This is called a liquidity trap. And once an economy falls into it, escaping becomes incredibly difficult. At first, a liquidity trap sounds like an economic mystery. Why would people refuse cheap money? Why would businesses avoid easy loans? Why would growth stop, when everything is designed to increase it? To understand this, you need to realize something important. An economy doesn't just run on money. It runs on confidence. And when confidence disappears, even unlimited money can't fix the problem. Let's break it down step by step. In a normal economy, things work like a cycle. People earn money. They spend money. Businesses earn revenue. Businesses hire workers. Workers earn income, and spend again. This loop keeps the economy alive. Now imagine that something disrupts this cycle. Maybe there's a recession. Maybe there's uncertainty about the future. Maybe people feel insecure about their jobs. So what do? They stop spending. They start saving. At first, this feels like a smart move. Saving money gives you security. But here's the hidden problem. If everyone starts saving at the same time, the economy slows down, because one person's spending is another person's income. When spending drops, businesses lose revenue. When businesses lose revenue, they cut costs. They stop hiring. Sometimes they lay people off. Now those people have less income, so they spend even less. And the cycle begins to collapse. This is where central banks step in. Their main tool is interest rates. If the economy slows down, they lower interest rates. Lower rates make borrowing cheaper. And cheap loans are supposed to encourage spending. People buy homes. Businesses expand. The economy grows again. But here's the catch. Interest rates can't go below zero, at least not easily. And when rates are already near zero, there's nowhere left to go. This is where the trap begins. Because now, even though money is cheap, people still don't want to spend it. Why? Because fear has taken over. Imagine you're worried about losing your job. Would you take a loan? Probably not. Imagine you think the economy will get worse. Would you invest in a business? Probably not. So instead of borrowing, you hold onto cash. And when millions of people do this at the same time, the economy freezes. Here's another important piece. Expectations. If people believe prices will fall in the future, they delay spending. Why buy something today, if it will be cheaper tomorrow? This is called deflation, and it's one of the biggest drivers of a liquidity trap, because it encourages people to wait. And when people wait, businesses suffer, prices fall further, and the cycle continues. Now let's talk about banks. Banks have money to lend. In fact, during a liquidity trap, they often have plenty of it. But they face a problem. There are fewer borrowers. People don't want loans. Businesses don't want risk. So money just sits there, unused. This is why economists say, it's like pushing on a string. You can offer money, but you can't force people to use it. Let's make it even simpler. Imagine a river. In a healthy economy, money flows like water, constantly moving. But in a liquidity trap, the river slows down. Then it stops. The water is still there, but it's not flowing. And without flow, nothing grows. Real-world examples make this clearer. Japan is one of the most famous cases. For decades, Japan has had near zero interest rates. The government and central bank tried everything, but growth remained slow. People kept saving, businesses stayed cautious, and the economy struggled to expand. This is often called a long-term liquidity trap. Another example appeared during major global crises. When fear spreads quickly, people prioritize safety over growth. Even when borrowing is cheap, they avoid risk. And the same pattern repeats. So how do governments try to escape this trap? They use stronger tools. One method is government spending. If people won't spend, the government spends instead. On roads, infrastructure, jobs. This puts money directly into the economy. Another method is quantitative easing. Central banks create money and buy financial assets. This increases liquidity in the system. But here's the problem. These solutions don't always work perfectly. Because the real issue isn't just money. It's psychology. If people don't feel confident, they won't spend. And without spending, recovery stays slow. A liquidity trap is not just an economic failure. It's a confidence failure. It happens when fear becomes stronger than opportunity. When people choose safety over growth. And when money stops moving. Even if there's plenty of it. It reveals something powerful about the economy. It's not controlled only by policies or interest rates. It's controlled by human behavior, belief, expectation, trust in the future. And when those break down, even the strongest economies can struggle. So the real question is not just how to fix a liquidity trap. The real question is this. If the next crisis pushes us into one again, will we know how to escape it? Or will we stay stuck, longer than ever before?